most economists expect Governor Lesetja Kganyago to hold the repo rate at 3.5% when he makes that interest rate decision today. They believe the high unemployment rate and slow economic growth make a compelling case for holding it at these current levels or dropping it by 50 basis points. But what does this mean for you and your personal finances? Head of Financial Education at Old Mutual, John Manyike, joins us to talk about this and what we can expect from the Reserve Bank's monetary policy meeting today. John, a very good morning to you. Thank you for joining us. What are the expectations ahead of this meeting?
Well, we don't expect any surprises. I mean, there's nothing to suggest that the MPC will increase interest rates. However, we might see a normalization cycle kick in perhaps early next year. Even when that happens, we don't think that it will be very aggressive. We think it will happen gradually. But at this point in time, we expect the interest rate to remain the same.
During these times of low interest rates, what should consumers be benefiting from a time such as this? I mean, where are the loopholes to take advantage of this record low percentage?
Well, you know, I'm glad you asked that question because interest rate means different things to savers and borrowers. So whilst it provides very little reward for savers, but it certainly does present a lot of opportunities for borrowers, but not only just borrowers, but wise borrowers. Because if you are, a consumer, you have an opportunity to pay down your debt faster because interest payments are fairly low. It makes home ownership realistic, especially for first-time home owners or home buyers. But also for those who want to invest in real estate, I think this would be a great time to do that because if you get a second bond and get a tenant in there, you're more likely to get a decent rental income, which would actually service your bond whilst your property is appreciating in value. But I think the most important thing for consumers here is to try and leverage this low interest rate environment by paying down debt so that when that cycle changes, then you know that at least you've made a dent, a positive one for that matter, in terms of the balance on your debts.
You talk about buying a home and taking advantage of a cycle. Should one, for instance, be considering buying applying for a second bond, what are some of the important factors to consider here? Should one be thinking of fixing interest rates here? And if so, how does that benefit a buyer in the long run?
Yeah. So look, if you, let's say for argument's sake, you decide to increase your monthly installment on your mortgage bond, what it means essentially is that you're going to reduce the interest, and cut the number of years that you have to be paying that bond. That's the advantage. But for those who decide to buy a second home and probably perhaps even get a tenant in there, at least your tenant will take care of your monthly installment. So now you have two properties and the other one being serviced by a tenant, and you can do whatever you want with that investment. So it's a good thing, but it's also a good time to speak to a financial advisor to perhaps explore other instruments that have a better yield. Because you have to be really creative to find a decent return when it comes to savings and investment. But that's why it's important to partner with a financial advisor.
John, not everyone is in that position to think of, working on removing debt or looking to buy apply for a second loan. People have lost jobs. Some people are still operating on 70 or perhaps have lost so much of their salary because of the salary cuts, and institutions haven't recovered and are still paying their employees a certain percentage point of their salary. What then happens to that consumer? How do they benefit from this interest rate?
So at this stage, for people like that, it's really about paying. If you cannot afford to increase your monthly installment, at least at this point in time, your installment will be much more affordable because of the low interest rate environment. But you need to start thinking creatively because when the cycle turns, you run the risk of not being able to afford that bond and end up defaulting. And that's why you need to start thinking of creative ways. Are you going to perhaps look for alternative streams of income so that you can, so use this time, to find other ways, either to increase that income, or, if you feel that it's even tough now as it is, I mean, you do have an option of downgrading, but at least you can still afford a much cheaper home without actually losing much. So this is the best time, because if you try to do that at the later stage, when interest rates are higher, you might actually not qualify.
I know that the Reserve Bank has voted to keep the benchmark repo rate as it stands, but does it have leeway at all to drop one last time?
I doubt it. I think this is the lowest it's ever been. It's highly unlikely that it might go lower than that, because, I mean, they have to strike a balance. I mean, as I said earlier, I mean, a low interest rate environment, favors borrowers and less of savers. But you also do want to create a bit of incentive for people to continue saving. Well, the good news is that it does stimulate business spending, consumer spending, which is actually good for our economy.
And what sort of advice would you give, very lastly, as we wrap things up, John, for consumers to perhaps take advantage, even those who may be not in a position to do so during this time of low interest rates?
Yeah, so those who can, pay down your debts, pay a little bit more than what is required, so that when the cycle turns, you are in a better position in terms of your balance. Speak to a financial advisor to explore other instruments that could give you a better return. But, use credit wisely and sparingly.
Very well. Thank you so much. Let's leave it there for now.